We are talking 203Ks.
You know, we hear the phrase generational wealth tossed around all the time these days.
All the time.
And it usually brings up these images of, like, massive trust funds or complicated stock portfolios.
Or inheriting a factory or something.
Exactly. But today, we're looking at something much more tangible, something that might be literally sitting in your backyard right now, just growing weeds.
Or hiding down in your basement, currently serving as a glorified storage unit.
That's it. We are diving deep into the world of ADU accessory dwelling units.
Yeah.
And we're not just looking at the pretty pictures on, Pinterest.
No.
We're tackling the two biggest hurdles that stop people cold. The zoning red tape and, of course, the big one, the money.
Right. How do you actually pay for it?
How do you pay for a six-figure construction project when you don't have six figures just sitting in the bank?
And that's really the mission of this deep dive.
Yeah.
We've combed through a stack of really specific high-value documents for this one. We have the official DC Homeowners Manual for ADUs, details on a pilot program called RAAP, and a very technical but very revealing interview with a lending expert, a guy named Lewis Hibbs, about the FHA 203K loan.
That interview with Lewis Hibbs is, I think, the key to this whole financial piece. But before we get to the how, let's just clarify the what.
Good idea.
Because I feel like people hear ADU and they just think, oh, I'll throw a mattress in the spare room and I'm done.
And that is exactly what it isn't. The DC Homeowners Manual is really rigorous on this definition. An ADU isn't just a room.
Right.
It's an independent dwelling unit. It needs 4 specific things: a kitchen, a bathroom, a living space, and this is the crucial part, a separate entrance.
So if I have to walk through your living room to get to my apartment, it's just a roommate situation.
Correct. Not an ADU. Independence is the key word here. It could be a basement apartment, a garage you've converted, or one of those, trendy backyard cottages. But it has to function on its own.
Okay, so why is everyone suddenly talking about these? Why go through all the headache of construction? Is it just about trying to get some extra Airbnb money?
I mean, that's part of it for sure. But the sources point to something much deeper. There's a why here that's driven by a genuine crisis. Lewis Hibbs mentioned a really personal example in his interview that honestly just stops you in your tracks. He talked about aging in place.
This part really stuck with me. He mentioned his own grandmother.
Yeah.
She was in assisted living, and he shared the cost. It was north of $5,000 a month.
$5,000 every single month. That's $60,000 a year just vanishing into rent for a facility.
And when you hear a number like that, suddenly taking out a $150,000 renovation loan doesn't seem like debt anymore.
No, it looks like a savings plan. It changes the math completely. If you finance an ADU to move a parent onto your property, the monthly loan payment is often a fraction of that fee.
And you keep your family close. They get to keep their independence because of that separate entrance.
And you're building equity in your own asset instead of just, paying rent to a corporation.
And then there's the bigger picture. We can't ignore the housing shortage. The D.C. mayor's forward in the manual explicitly states this goal of 36,000 new homes by 2025.
The city needs this. They call it smarter growth. It's about adding housing into existing neighborhoods without building, massive new towers everywhere. It's gentle density.
So the city wants it, and families need it. But then you hit the wall, the rules. If I own a house in D.C., can I just start digging in my backyard tomorrow?
Absolutely not. But the landscape has changed, dramatically. We have to look at September 6th, 2016. That date was a watershed moment for D.C. zoning.
What happened?
Before 2016, getting an ADU approved was, it was almost impossible. But after that date, the regulations shifted to make them matter of right in most residential zones, what they call the R zones.
Matter of right. That's a legal term, but let's unpack it. It basically means you don't have to beg right.
Essentially, yes. It means you don't need a special hearing. You don't have to ask your neighbors for permission. If you follow the published rules for size and setbacks, the city has to issue the permit. You have the right to build it.
Unless you live in Georgetown.
Of course. There's always an exception. Zones R19 and R20, which is Georgetown, still require special exceptions. Historic preservation is a really powerful force there.
Okay, so for the rest of us in normal zones, what are the physical limits? I can't build a second house the same size as my main house, can I?
No, it's accessory, so it has to be smaller. If you're building a detached cottage, The footprint is generally capped at the greater of 450 square feet or 30% of your required rear yard.
450 square feet, that's a studio apartment.
It's cozy.
Yeah, a tight one-bedroom if you're really creative.
Think tiny home vibes. Height-wise, you're limited to 22 feet, which can get you 2 stories. But honestly, the biggest physical hurdle isn't the backyard cottage. It's the basement conversion. This is where people get into a money pit.
The ceiling height.
The ceiling height. In DC, code typically requires a 7-foot ceiling clearance. If you have an old row house with a basement that's like 6'5",
You have a big problem.
a very big, very expensive engineering problem. You have to lower the floor.
Which is called underpinning.
Yes.
Yeah.
And I want you to just visualize this. This isn't just digging out some dirt. You are digging below the foundation of your own house. You have to pour new concrete footings under the existing walls to support the whole structure.
That just sounds incredibly expensive.
It is. You're looking at a starting cost of around $30,000. And that's before you put up a single piece of drywall or install a toilet.
It's a 30 grand just to create the empty box.
Yeah.
This brings us perfectly to the core problem we said we'd solve. Money.
Right.
Most people do not have an extra 150 grand sitting around. And traditional banks often hesitate to lend that much for a renovation.
They see it as a big risk, especially if you don't already have massive equity.
This is where that Lewis Hibbs interview provided what feels like a magic wand. The FHA 203K loan. We need to unpack this carefully because it almost sounds too good to be true.
It's a really unique financial vehicle. The 203K solves the problem by combining everything into one transaction. It's one loan that covers the purchase or a refi of your current mortgage, plus all the construction costs.
So you're not getting a mortgage and then trying to get a separate home equity loan or something.
Exactly. It's all one bucket. But here is the deep dive insight that really matters. It's how they calculate the value.
Yeah.
A normal home loan looks at what your house is worth today. The 203K looks at the future.
The after-improved value.
Precisely. Let's just do the math to make it concrete. Say your house is worth $500,000 today. You want to do a $150,000 ADU project.
Okay.
A normal bank might say, you don't have enough equity, but the 203K lender asks the appraiser, what will this house be worth when the ADU is finished?
And if the appraiser says, well, with that new income-generating unit, the house will be worth $750,000.
Then the lender bases the loan on that $750,000 figure. In fact, they can lend up to 110% of that future value.
Wait, 110%? Why would they lend more than the house is even worth? That sounds risky for them.
It's actually a strategic buffer. Lewis Hibbs explained this really clearly. Not every renovation gives you a dollar-for-dollar return. You know, if you spend 10 grand on a new sewer line,
Right.
your home value doesn't instantly jump by 10 grand. The 110% gives you room to do the necessary, unsexy work without killing the whole deal.
That is a huge safety net. But there's another hack here about qualifying for the loan that I've found fascinating.
Yeah.
If my debt-to-income ratio is already tight, adding a $200,000 construction budget seems like it would disqualify me instantly.
You'd think so. But the ADU has a superpower.
Yeah.
Income. The lender can look at the projected rental income from the unit you haven't even built yet.
So they're accounting rent from an imaginary tenant.
In a sense, yes. The appraiser estimates the market rent, say, $1,800 a month. The lender takes 75% of that to account for vacancies and adds it to your qualifying income right now.
That is why the apartment basically pays for its own loan application before a single nail is hammered.
It can significantly lower your debt-to-income ratio. It unlocks the loan for people who couldn't qualify otherwise.
Okay, I want to circle back to something technical we touched on.
Right.
The breezeway. This was a detail in the Hibbs interview that's actually critical if you want a backyard cottage.
Ah, yes. The classic collision of zoning rules versus banking rules.
Right.
DC zoning says, sure, build a detached cottage, we love it, but the FHA 203K loan guidelines say we only finance additions that are physically attached to the main house.
So if you want the detached cottage, you can't use this amazing loan? That seems like a deal breaker.
It would be, unless you build the breezeway.
The loophole tunnel.
Precisely. If you build a roofed connection that structurally ties the main house to the ADU, the bank considers it attached. It doesn't even have to be like a fully conditioned hallway. It just has to connect the roof lines.
So you build a little roof over a patio path, and suddenly the bank is happy, and you get your money.
That is exactly the kind of nuance that saves a project.
Okay, let's talk risks, though, because construction is messy. Hibbs talked about the 310% as safety measures. We covered the 110% LTV. What are the other two?
The second is the contingency reserve. The lender forces you to pad the budget. They'll add an extra 10 to 20% on top of whatever the contractor bids.
This is the oops fund.
It's the we opened the wall and found termites fund, or the sewer line has collapsed fund. It just sits in an account. If you don't use it, it pays down the principal at the end. You don't lose it.
That's actually really comforting. Prevents you from getting stuck halfway through. And the third, 10%.
That's the holdback. This one's for the contractor. The lender holds back 10% of every single payment they make to the builder.
So if the builder does $10,000 of work, they only get a check for $9,000.
Until the very, very end, they don't get that accumulated 10% until the project is 100% complete and signed off.
That's a powerful incentive to actually finish the job and not ghost the homeowner.
It protects the homeowner. But it leads to a very difficult reality about this loan. The contractor relationship.
Hibbs was very stern about this. No upfront cash.
And this is a deal breaker for a lot of contractors. Normally, you might give the guy 30 grand up front for materials. With a 203K, the contractor gets $0 until work is done and inspected.
So they have to float the entire project.
They need to have the wherewithal, as Hibbs put it. They need enough cash in their own bank to buy the lumber and pay the crew before asking the bank for reimbursement.
That has to limit your pool of contractors significantly.
It does. You can't just hire your handy neighbor, and the lender will validate them. Check licenses, insurance, references. And he noted they check for similar work.
Right, the guy with great references for roofing.
Exactly. If you're building a 2-story addition, a reference for a shingle job doesn't count. You need a pro who understands this specific cash flow.
Speaking of pros and costs, let's talk numbers. The DC manual gave some ranges, and they are not for the faint of heart.
They are not. For traditional stick-built construction, you're looking at $300 to $400 per square foot. A full renovation of a garage or basement is easily going to land between, say, $125,000 and $200,000.
That's a huge investment. And I know people are wondering, can I do it cheaper? What about like shipping containers? We see them everywhere.
We actually have a data point on that. Alluvial Construction was quoted offering a 160 square foot container home for around $72,000.
Okay, $72K sounds a lot better than $200K.
It does, and it's faster, maybe 90 to 120 days. But
There's always a but.
Logistics. Especially in a place like DC, you can't just drive a container into a row house backyard. You usually need a crane.
I have this mental image of swinging a massive steel box over a row of historic townhomes.
That is exactly what happens. It requires permits, street closures. Plus, you still need a foundation and utility hookups. The 72 grand is for the box. The site work is extra. The savings might shrink fast.
So it's an option, but not a magic bullet. What if I'm a DC resident listening to this and I'm thinking, I don't have the income for a big loan? There's that pilot program, RAAP.
Yes, the Residential Accessory Apartments Program. This is from the DC Department of Housing and Community Development. It's designed specifically to help lower and moderate income homeowners.
How does it help? Does it just give you the money?
It provides financial support for the renovation. Up to $120,000 was cited. That's real money that can make a project happen.
But government money always has strings attached. What's the catch?
The catch is affordability, the golden handcuffs, right? If you take this funding, you are legally required to rent that new unit to a household with an income below 60% of the median family income.
So you can't use city money and then just put it on Airbnb for $200 a night.
Absolutely not. You are signing up to be part of the affordable housing solution. It limits your rental income upside, but it makes the construction possible.
Seems like a fair trade-off. You get the asset, the city gets an affordable unit.
Exactly. And for many, it's the only way.
So if I pull the trigger, whether it's the 203K or RAAP, what does the timeline look like? When do I actually have a tenant?
You definitely need to manage your expectations. This is not fast. Just closing the 203K loan takes about 60 days because of all that contractor validation and the complex appraisal.
And then construction itself.
6 to 12 months, easily. And you need what Hibbs calls your starting lineup. The loan officer who knows these products, a HUD consultant, the right contractor, and a realtor who gets it.
And when the paint is dry, you still aren't done. The paperwork continues.
The license. You cannot legally collect rent in DC without a basic business license, a BBL. And this gets tricky depending on your zone.
Right, the manual distinguishes between R zones and RF zones.
If you're in a detached house in an R zone, you need a one-family rental license. It's pretty straightforward. But If you're in a row house or flat zone, an RF zone, adding a basement unit technically changes your building to a two-family dwelling.
That sounds like a small change. Does it actually matter?
It matters immensely. It requires a whole new certificate of occupancy. That means a rigorous inspection for fire separation, egress windows, interconnected smoke detectors. You have to prove the building is safe for two separate households.
So don't assume you could just finish the basement and hand over the keys.
Never assume. Check the certificate of occupancy requirements before you even frame the first wall.
We have covered a massive amount of ground here, from keeping grandma close to the financial mechanics of borrowing from the future to, the logistical reality of cranes and permits.
It's a complex ecosystem, but I think if there's one big takeaway, it's about redefining what a house is.
It feels like the American Dream 2.0. It's no longer just buy the house, plant a garden. It's buy the house, develop the asset, create options.
It's about resilience. That's the word that keeps coming to my mind. An ADU creates financial resilience through rental income. It creates family resilience by having a place for aging parents or adult kids.
It turns the home from just a passive expense into an actor tool.
Exactly. But, and I cannot stress this enough, it all starts with a map.
The zoning map.
Before you call a contractor, before you call a bank, go to the DC Office of Zoning website. Type in your address, see what zone you're in.
Because you don't want to fall in love with an idea only to find out you're in a historic district that forbids it.
Knowledge is the cheapest part of this entire project. Load up on it first.
That is the best advice to end on. Go look at your backyard with fresh eyes, check your zoning, and think about what that space could actually be doing for you. Thanks for diving deep with us.
My pleasure.
We'll see you next time.